Okay, now we're on video number 2 or part number 2, and we're going to get closer to discussing charts, which is where the real passion comes out for those of us who love the market like myself. And you're going to notice on screen the word naked charts. There's nothing dirty about this, but what I see from most people, pretty dirty charts, which are messy looking charts where you can't even see the price behavior. And so I want to show an example of what my charts will look like. You'll notice that there's volume information and a 20-day moving average on the volume, or a 20-period moving average on the volume. I use the 20 because Dan taught me the 20. But you'll also notice that I have no indicators or moving averages all over it. I may have another chart to the side that has the moving averages on it, so I know where those key areas are, but I need to see the chart clearly. Now, for some of you who are longer doing this, you may instantly start to see the patterns that are popping off the chart in this view. You may already see a benefit, and that's because clear charts or a quality chart program, unlike these web charts, in my opinion, a lot of junk platforms, you can't see what price is telling you. This is MultiCharts, is the trading platform that I use. MultiCharts is basically TradeStation, but higher resolution. And the benefit is obviously I can see right here with these bars patterns. I can instantly see things that some people can't see with all of the noise on their chart. If you can't see anything yet and you're newer doing this, you're going to see it after the course because you're going to learn how to read price. But if you've been doing this a long time, this may instantly show clearly a couple of patterns and behaviors that you're not noticing in your current charts. Time frames. This is one that becomes a discussion in chat all the time as people ask me, what do I see on a 5-minute chart? I don't see 5-minute charts. I look at weekly, daily, and hourly most of the time. I may go to a 30-minute every once in a while. I may go to a 240-minute chart, which is a 4-hour, and look around. But I'm looking for an entry that is on the hourly or half-hour chart that is trading a reaction that will affect the weekly and the daily. And the reason for that is I want bigger swings. So I do suggest that people look at my time frames and consider them, especially those of you who center yourselves on 5-minute charts, who find this to be a very difficult endeavor. Bigger time frames are controlled by bigger traders. My feeling is the people at Fidelity, or at Vanguard, at Janus are not worried about what's going on a 5-minute chart. In fact, they're not playing that game. Now, they have algos and people that do play that game, but from a bigger perspective, they're amassing stock and they can't make any money on 5-minute charts. So when we move down in time frame and get below 30 minutes, my view is you are fighting algos. You're fighting HFT, that high frequency computer trading. You're fighting professional scalpers that know how to read the market and include the order dome flow. So these are the traders that are looking at the flow on each side of the bid and the ask, and they're scalping out profits from that. That's a different skill, but they're very quick. They're in and out in literally potentially seconds. So between all of these traders, you have entire floors of New York City, Manhattan buildings with PhDs sitting in a room finding a way to create a program to tear money out of the market. I mean, that's their goal, is to take a stream of cash out of the market. You're fighting some of the most brilliant minds that exist. I don't go down to their level because I can't fight them. They have tools and computers and programs that are faster than I could ever think. They work in the milliseconds. So let's go to the part I can control, which is layers. This is the entire theory upon which my process is built. I call it confluence in chat sometimes, but layers means we're going to stack tools together to trade the market. meaning I do not believe that any one factor is a totally reliable trading entry. If I show you all the double bottoms in the market, if I show you 100 double bottoms in the market, depending on what the context is, half of them or more will be bad. They won't work. So why go into the market relying upon a pattern which we know will often fail? Why not put that pattern together with three other things and create a trade that has multiple reasons from multiple disciplines, maybe, that will be a more reliable signal? So each tool that I show you will be weighted differently, and we will learn to use those to provide a higher probability entry and odds to our trading. If you think about it, it's the concept of putting multiple traders in one situation. So if you had all the fib traders and you have all the pattern traders and you have all the support and resistance traders all looking at the same area, and they all are trying to hold up one spot, well, there's a number of bodies that are all stacking up there. That's probably a good area where we want to look. We don't want to find one set of disciplined traders that are in that area, because we need those big professional traders to add up to defend our positions. So we're looking to trade with, protection. So the first layer that we're going to discuss to create this is the trend. And the definition of the trend, even though some of you know this from 30 plus years of trading, is an uptrend is higher highs and higher lows. These are swing points, higher highs and higher lows. Notice that I left one swing without a higher high because it wasn't. And that's just to remind people that a trend doesn't have to be perfect higher lows and higher highs. It's the general swings of what's happening. And then there's a downtrend, which is a series of lower highs and lower lows. And you'll notice in this image, there's one missing lower high, which is a double top, basically, a test of the same level. And that's because, again, a downtrend doesn't have to be perfect. It's what the majority of the swings are, lower highs and lower lows. Trend power, and this is about the word persistence. The trend is the most powerful force in the market. You never underestimate the power of a trend. I thought this market, after the 2013 major run, was going to top out in 14. I thought the same in 15. We're in 16 and it was higher. The trend is a powerful tool. It continues in some cases, like in commodities. The cycle could be 30 years in one direction. Interest rates have been dropping since the 80s. We see this as being that trends last longer than people can understand and identify with even charts. It's hard to identify when a trend will end. It's easier to identify where a swing will end, but where the actual final trend will give up and completely reverse is a very difficult thing. Like I said, I called before AZO the top at 250, and it's a $700 plus stock. So don't fight the trend, and certainly don't underestimate that the foundation of all trading should be understanding that if you're building a house and you put in concrete on the bottom so that it's stable and doesn't sink in the mud, that's what the trend is. We need to know that when we're thinking about trades. Simple picture of an uptrend. I like to show this one because I screwed up this trade. It was beautiful and gorgeous, and I missed that entire up run. I was focused elsewhere and I missed simple and clarity. And this was beautiful, light, L-I-T-E. The stock Dan caught, and it was just absolutely gorgeous uptrend. Higher highs and higher lows, and persistent as can be. Here's a downtrend. This is a stock that recently people have been talking about, which is Triple D, 3D printing, and this stock has been in a downtrend. That red arrow just denotes to show you the thing has been down. In fact, this has been down for years, and recently it's popped off the bottom, but it's going to take a while for believers to come back to a name like this. What is a trading range? Unlike a trend, a trading range is the time when a stock or market is trapped between two levels, and those levels are usually referred to as support and resistance. While this definition is similar to the term bases that are used in that book, How to Make Money in Stocks, A trading range has no rules, patterns, or time periods to define. In other words, a base is usually what follows as a trading range after a 20% up move. Price consolidates for 4 weeks or longer and creates one of the main patterns we're going to discuss, and then breaks out of that range. And while bases are more important than trading ranges because they're larger trading ranges and they're defined trading ranges, it's important to note that when we're in a trading range, we have to adjust how we view price, because price is caught between two areas. So maybe we're able to sell the top end of that range and only buy the bottom of that range, and vice versa. We can't expect it to leave that range until we see a breakout. And that's what we're looking for breakouts, is to leave a range. Here is a trading range for the stock WIN. This actually is a base. It's basically a flat base, and price is caught in this channeling behavior back and forth. I really don't call them channels when they're flat like this. It's a flat base or a flat trading range. And you actually can notice there's one attempt at the end of this chart, which I'll highlight and kind of give you a laser point towards so you can see it. But there was an attempted breakout here, and it failed and fell back in the range. And that's not uncommon in a trading range. It takes a lot of power for price to leave that range. Most traders in that range are people that, if they believe in the stock, there is professional money selling into those highs. It's very visible in this chart that they're selling into those highs. And what it takes to leave that is a whole set of believers that think the stock can go much higher and want to invest above that price and hold that price with higher lows above the trading range. I just gave you a major hint about breakouts that's important, which is you need higher lows above the trading range. Or in the case of a down move, you need lower highs below the trading range, because it's stuck in that range. A little spike above the range does not mean anything changed. It means that a move was above and could easily shake out some people or bring some new retail rookies in so they can dump it right back in the range. So it's easy to fake people in that spot. For definition purposes, what is a pivot? A pivot is a term used to define swing points in the following slides. It's the same as the point where we see a reversal or turn. A swing high or a swing low. A swing high is a reversal point that forms on a move up. You see like a swing on a swing set. It slides up and then back and forth, and as it moves up, it pivots and turns back, and as it's turning back, that reversal point is called a swing high. And when it swings to the low side, it ends up turning around, and as it's turning around, kicks the other direction, it's a swing low. Gaps. Now we're getting into real price action, which is, this is the first kind of gap when price has turned and there's a gap that occurs. This is the first gap, and it's called a breakaway gap. And gap equals power in most cases. What I mean by that is, a gap means that somebody got it wrong. When you get a news story or an event that is different than what Wall Street thought in the past, you will get a pop that will open completely differently than where price closed. And that means somebody probably got it wrong. In fact, professional money may have it wrong. And power usually moves in the direction of that gap. That doesn't mean always, but generally, gaps show power in the direction of the gap. So in this case, the S&P gapped up, and you can see the resulting action as it was powerful in that direction. Now there's multiple types of gaps. After this breakaway gap we discussed here, there are continuation gaps where price closes and the low of the next day or the open of the next day is higher than that previous day. And you can see those are continuations of price as it continues to power ahead. And that was all led by that first breakaway gap. And that's a powerful trending move. Now, there's another kind of gap, which is called an exhaustive gap. And right up here, you'll notice price closes and the open and low of the next day is higher. leaving an open gap there. And the next following day, right above the red dot here, it closes the gap the next following day pretty quickly. That is exhaustion. That means that buyers are exhausted. They had been strong, and then now they're exhausted. They're not able to hold that momentum, maintain that unbelievable strength. They filled the gap because they're tired. And that kind of gap gives you clues about that quick filling, gives you clues that maybe the power has run out for the gapping. And you may not notice it here, but when price here gapped down at the low here, the next day it filled right here. That was a good sign that that was exhaustive on the low side. So these are powerful tools to read the momentum and power of gapping behavior. This is called an island gap reversal, and I want you to understand that this is a pattern that is created by two gaps. You'll notice that we get this gap where it gaps up on the S&P. This is an hourly chart. We gap up, price holds a range. This just happened recently in September. And then it gaps down completely. This left an island of price where traders here are trapped. They are left hanging here. If they were long, they're completely trapped here. If they're short, they're better off, obviously, because now this is a win for them. But if they were long in here, this is a trap. And so there are going to be sellers, people getting rid of positions. And that's why we get this sharp move down. So two gaps across from each other like this that leave space in between leaves an island of trapped individuals. And that can create powerful moves. Notice that one of our favorite names recently that was beautiful to the upside and a nightmare to the downside if you held this, which we didn't. But Acacia, ACIA for the hourly chart, notice this had a gap down right here, and price came back up, and actually right here, it gaps up toward filling this prior gap and then gaps down, and it left a complete island alone. The people in this area of the chart that bought it are completely trapped. And thereby you see them exiting and trying to get out of this thing right here. And that has led to the downfall partially for this ACIA. It was not good behavior. Now we'll also notice something about gaps, and that is when price fills a gap, there is often a reaction. Most gaps get filled. When they don't, that means there's incredible momentum and power to the market or the index or the stock where it's happening. When a gap fills, we have to look at the reaction. Many times the gap will fill and the immediate reaction will be reversed back in the direction of that gap. But if it doesn't react, that's also a sign that price is pretty weak, that it's not even trying to lift back up. In this case, in the case of Facebook, it filled the gap, closed on almost the lows of the day, and the next following day took out the high of the bar of the day of the move down. So from that point on, it just flew. And that's not uncommon for gap filling. When you fill the gap, you often get a reaction like that. The second layer, when we leave trends and we leave gaps that are in the chart, is support and resistance. Now, a support level is an area on the chart where buyers are holding price from trending lower. And a resistance level is an area on the chart where sellers are holding price from trending higher, meaning they're dumping stock, they're distributing stock. This chart is a monthly chart. I want you to see that. This is a monthly chart on the Dow going back from 1974. And I want you to see that for the entire 70s, the whole time, price could not get through this level, around 1,000 for the Dow. Just could not get through it for a decade. Price was able to hold certain lows. You can see two lows here holding. You can see lows holding in 78 through 82, where there was a support point where price was defended, but it couldn't get through that range of 1,000 or so on the peaks for a decade. But once it was able to get through, price completely changed composure and flew up to nearly 3,000, 2,800 up here. And I want you to understand this is true about bases. The stock can be a nothing, but for some reason, if the base is big and beautiful and long enough, the stock will move 20, 30, 50%, even if it's a laggard. Strong consolidation periods where people forget the name or people get bored or the average active guy isn't toying with it every day. When they go quiet, they get tight and they kind of sit and rest, and the volatility falls out of it. And then suddenly it hits an area where it breaks, and all of a sudden all of that interest comes back in, and that interest brings in buyers and causes that big change in behavior. And you'll notice that after it broke out, it found a resistance period from 83 to 85 basically in here. Could not get through. But once it broke that, very strong move. Then rested, found new higher lows here, found new peaks that it couldn't get through, probably almost a year of behavior, and then busted through that and flew straight up. And notice, the sharper the move got, the more wild it got, and then it shot down. In this 1 month, it got clobbered in 87. But it even stopped on when it got clobbered down here at this prior support. And it found new resistance up here, even into 1989. So the point I'm saying here is this concept works if we go back to 100 years. It probably works if we go look at the tulip craze that happened. It probably worked thousands of years ago because humans create support and resistance by supply and demand. So this is the same as an eBay auction, why an iPhone 7 right now is popular and shows demand, and a BlackBerry Curve or a StarTech Motorola flip phone is probably not doing pretty well because the technology is only 10 years old, okay? Now, identification of the best support and resistance levels, here's a trick, comes from patterns, which we'll discuss later, like double bottoms and double tops. They are more powerful than standard support and resistance because the pattern creates more believers in that support and resistance area. That's why. Support and resistance time frame value. Now, this is important to think about. The larger the time frame, the more valuable the support and resistance area becomes, or the areas become, because the larger the time frame, the more market participants that exist. If we look at a weekly chart and find a set of lows that are all holding perfectly, there are thousands, millions, or billions of dollars defending that area. There are entire funds that have their protection at that level. It matters more than a 5-minute supporting low with 3 little 5-minute bars. That can be broken because there's very few participants defending it. But on a bigger basis, the big money that's sitting behind a weekly level or a major daily level is much larger. Now, identifying support and resistance is fairly easy. We look for 2 clear pivots or swing points, and we then are able to point forward to the future, toward the right, to determine where that area is. In the case of the red 1 and 2, the next area was resistance right into here in the case of Baidu. For support, green 1 and 2 were 2 swing areas, and then you can see yellow arrows toward the 3 additional tests of that area. Notice it did not hold to the tick. Support and resistance are an area. And one of the ways to fuel better moves, the way that Wall Street works, is to shake out below where people see that perfect support. See, your average rookie or person afraid of the market, when it gets down to that green line, they're thinking, oh no, this is going to fail. I'm going to lose money. And so what does the market do? Well, professional money lets it undercut. Maybe even they push it lower. I can't say what they do, but I've seen it too many times. They undercut. And as soon as everybody's screaming all this negative stuff and selling their positions and jumping out the window, it jumps right back over that green support line and starts flying the other direction. In which case they all realize they made a mistake, and some of them chase to get back in. And some of them just complain that they missed it now. And some don't want to go back in and then chase it late. But the market does this on purpose. And in fact, the more people that are fleeced under that green line, the more powerful the move often is to the other side. You'll notice that when it undercuts this time and closes back above support, it rallies right up to this peak, this prior peak instantly. Took 2 days afterwards. You'll notice this one, it breaks underneath and it just shoots using a strong trending action right up to the top on the other side. These shakeouts are actually, they're called shakeouts, but these shakeouts are actually good for us. Perfect tests do not refuel moves and create as much momentum. More momentum is created when people are, weak hands are shaken out. And I know that sounds terrible, but you got to kill a few people to go and really start the ramping in the other direction. And so they do wipe out traders to create the next strong move. Now, prior support has memory. This is a weekly chart for the S&P, SPY, the ETF, and each one of these lows are major support areas. The reason I am defining these pivots as major lows is because this is where price rejected on the way down in an uptrend. This is uptrending, and you can see price fell in these areas and rejected these lows. They turned around sharply and moved higher. Now, we have a number of people in chat that have been saying this market's in a downtrend and it's a terrible market and all this, but this is the current weekly chart of the S&P. And no matter what your opinion is, all that has happened in 2016 is price has perfectly held the range and support of the last year plus and has overcome the top of the resistance of that range, but hasn't really gone anywhere. But if you think this is a downtrend, this is a quick way on this time frame to show you price has held up perfectly for all of 2015 and 16 to those lows that started in 14. We found support and we've been holding it. And that has provided multiple trades in the end of 15 and 16 that were strong longs off of this beautiful pattern of support. Prior resistance has memory as well. When we have a weekly chart, this is going back to 2000 and 2008 and 2007. 2008 is the year I got murdered, my second year trading. You'll notice that price finds a peak and held that peak, and lower highs, lower peaks, and it moved down until such time where in 2009 it finally changed its behavior. But price remembers those prior peaks, and you need to know that and look left when you're looking at your chart to see what the hurdles are. Getting past these points are hurdles. So knowing what we learned about support, this is ACIA, this is an hourly chart, and you can see that price has rejected here at this point. Price rejected twice right here. Price came close but never dug into this area right here, so it's not really a support test. Here price tested into the range, and right here tested into the range. And so when price held this range, this was the side of price that was buyable. If you were looking at just support and resistance, this was a buy zone. Would you want to short into this level? No, because there's buyers that stand here. And it doesn't matter whether it worked. In this case, it moved up and there was a trade that existed here, but it gapped down and finally broke that support. The end result is we need to know where we are in location or context. So this was the supportive area. This was a resistance area. Notice that when we got above this high, there's two peaks on the hourly here, and it was sold off. And when price even attempted to get up here, it gapped away from it right here. Gapped away from this top point. So were we wanting to buy up here? No. Was it possible to sell up here? Yes. Now, the trend was very strong at this point. It had come from 32 to 125 plus. So the trend was saying it's an uptrend, but there was a counter trend trade. Regardless of whether you took it or not, this is where you would have wanted to have sold into until a new breakout developed that took it out of this range very strongly. But I'll see people asking me right here on the chart, Should I take a long here? And they'll be disappointed that it goes up another $4 and I was wrong. I wasn't wrong. I just am not going to initiate up against a brick wall. I'm not going to run myself ragged into a hurdle with all of this space below me, all of this space to reach support. I'm playing on the wrong side of the field. It's kind of like the reverse of a baseball field or anything, any kind of sports game, how we want to play. In football, you want to kick the ball from as close to the end zone as you can of the defender's end zone, as close as you can. In this game, we want to start our play from the 1 yard line on our side end zone, and we want all that running room to get to the other side because our reward is bigger the further we keep running. But we don't want to be right in front of the end zone because we don't want our trade to go and run into a hurdle or the end of the game too quickly. We don't have as much reward that way. So unlike a sports game where the goal is to try to get as close as we can to make the shot, we aren't trying to get close to the red zone to make that shot. We want room and we want that big reward so we have the largest amount of cushion when we get to this troubled zone. Why this matters? Well, longs are higher risk up here and shorts are lower risk. And in the green zone, longs are lower risk and shorts are higher risk. Now, a breakout, which we'll learn later, changes this. But that's where we get into reading the quality of the moves. Once we learn quality of moves and we learn how to read price, we can tell that high volume broke this support and this could have been a short area even though it was a support area. The support area was failing and we can read that. But overall, we don't want to initiate shorts against this zone, knowing what we know until we see something special that changes our mind. Now, I've been asked for years how I determine what the distance is for my risk versus reward. And that's what I believe in trading is the risk, small, tiny risk for bigger reward. I learned that from watching Dan. He would not step out, even on 10,000 measly shares for him, he would not step out unless he was risking peanuts for a chance at bigger gains. He didn't believe he was going to take money out consistently looking for peanuts, trading it for a bigger risk. He just knew that. So I learned watching that in this case, for instance, this is support. There are two tests here which provide us two pivots. We could have potentially gone long here. We could have potentially gone long here. Each one of these longs, as we look around to the left, we see peaks of where price stopped. So if we had gone long here, we would have looked back at this peak and said, okay, so I have the distance from here to get up to here. When it hits this point, I better tighten up because it could easily stop here. And you're not seeing it in the chart, but Celgene's in a downtrend coming into this. So this pattern is not a beautiful, strong pattern on an uptrending market. It's a support point in a downtrending market. But you'll notice that price rallies up above this peak or these two peaks and then stops. And this is now a memory for the future. Price gets back down towards support. This becomes a buy potential area. And price rips back up and it gets into this prior memory right here. And we would need to take a target and shore up our stop because what can happen? Price can be rejected here. And we also know if price breaks through here, it may get up to this next red line. So when we determine what our reward is compared to risk, we look at the hurdles to the left. The more we look left, the more we see what happened. We can see the number of dead bodies on a chart and say, hey, everybody who's touched this thing for the last year is a loser. Why do we want to go long into every one of those peaks where they're going to be happy to sell their loser or dump their garbage the moment it pops up? They're just waiting for a chance to sell it a little higher or get back to break even. Now, here is an example of simple support gains. Simple support gains. Here's an uptrending stock. Amazon is in an uptrend for years. Strong stock. It finds a low right here. And this low, if you notice the bars match on the low, this was 2 days. It's like a mini double bottom for those that know what a double bottom is, but we'll get there. And price comes back to test there with a memory, steps into that area and just slightly undercuts, and then gaps up again, and rallies. Now, why? Because price is in an uptrend, and all it did was undercut a swing, scared a few people, took a few weak people out of the market, actually kind of a lot of weak people out of the market based on this volume, and went back in the direction of the trend. And the trend does this all the time. It's persistent. So you just saw a way to create a gorgeous, trending, easy trade. And yes, this is basic level 1 trading, but this trade is better than about 95% of the trades I see in chat. You will see people in chat talking about all kinds of trades where they made $3. Here is a trade that produces $100 in gains or more, and nobody's talking about this, and it's easy as can be. Do we miss these? You bet. Why? Because we're playing in the mud. We're down to those short time frames on 5-minute charts, and you're missing the clarity of the market. Now, why buying weakness is difficult? This is for all of the people that ask me, well, why can't we buy DDD off the bottom, or talking about a stock that's been going down for years like a GoPro or a Fit or whatever, and trying to figure out how to bottom tick it. I know you like the cheap stock. Heck, I know I trade Twitter because I could control it and play with it, and it was cheap and it was fun. But the truth is, that's something I'm trying to change about myself. Even I make these mistakes. And that is, when you're buying weakness, there are buried individuals on every peak above you. The moment the stock moves up, there's a seller waiting in the wings to dump this, or to try to get break even, or to get out of this, or to just feel like they made some of their money back. And so they're in your way. So the more damage the stock has taken, the more swing highs that are above you in price, the harder it is to climb the mountain. Same thing goes for short selling. I'll see somebody trying to short sell a strong stock, and it'll be an NVIDIA. In this case, it's a daily chart of NVDA. And why is it difficult? Well, because there's a bag holder to the left everywhere on each one of these swing lows. And some of them are huge traders that are defending billion-dollar positions. And their attitude is they can say to their trading team, look, give me all you got underneath that price. If they take it below there, give me all you got. Pick it all up there. We're gonna pop this back up. We're gonna hold it here. They can do that because they already maybe have enough money on the line that this extra 100 million isn't that much when you talk about they've got a $2 billion position. So the trend is strong. It's hard to fight. Now, when we look at support and resistance, I want to show you a perfect example of what trending support looks like. You'll notice that in the past here to the left, NTES was coming down and there's a few swing point highs, and it overcomes them right here. And I'm not going to explain the pattern or anything to the left because we're not there yet. But you'll notice I put a red mark underneath this, even though this is a green support. But I made it red so you're aware. This is the first higher low support above all of this. This is the first higher low where support is holding on a higher low. Not a lower low, but a higher low. And so we're starting to see a change in NTES right here. That could be bought, but that's the tougher buy. What is more interesting is when price finds these little ledges of support afterwards that provide strength to buy afterwards. Meaning we don't have to trade just one signal. We can add those signals together, those clues to the left, to provide us more accuracy to our trading. In this case, you may have skipped this first support level. Then when it held up on the second one said, it already made one higher low and held beautiful there. I'm going to start when it breaks out of this one. And you do, and you move your stop underneath this support level, and you let price do its thing. And it never takes you out. It makes higher lows and higher highs, and it lets you ride for this. This trade right here, even the second entry, not the first one, but the second one, gets you in somewhere around 190, under 200, and provides you a $70 move on this chart. And it does it with almost no headache and no skills beyond support and resistance. Now, I don't enter using one tool, not just support and resistance. I always use multiple tools. All tools fail individually. As a group, they increase odds. Now, what I also want you to note in the chart is I wrote stair-stepping up is very good. Why? Think about it this way. Think about it as like a fort or a moat underneath each one of your buys. If there's support underneath you, then somebody's defending that location. If you're stair-stepping, that means each one of these locations, there are defenders that are holding this up. If price tries to drop down, they will find defenders trying to hold it here, 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 and even hold it here. If it's a sharp, straight trend with no stair steps of support on the way, it's easier to slice down. So as a holder of stock, I love to see these higher support trending environments because I feel that there are more people that have my back and more protection on the path. Without it, it's easier to come after me at this lower stop right in here. Now, 5-to-1 risk, I enter here, I stop here, may not be a trade you want to take, but it produced more than 5-to-1 here because that was a pretty small stop. Now, that may have been $10 on this chart. We may have had to go to a lower time frame to have found an entry off of that support. But my point being that we're looking to enter where there's defense, protection. And remember, the larger the time frame, the better the protection. Think of weekly as being castles behind you, protecting your side of the world. Think of daily as being smaller forts than the castle. Think of hourly as maybe being a small moat. And think of the 5-minute as being, one guy standing there trying to hold down an army. It's not very easy. Okay, so we treat them for the quality they present. This is incredibly powerful, this thinking. It can change your trading. Think about this on an emotional and a trading level. Bulls show power breaking resistance, and bears show power breaking support. So while we have a room full of people that are all screaming, the stock is falling, it's falling and falling, it's falling, and the stock is in between support and resistance. As it's hitting support and bends just slightly under it, watch as everybody is freaking out and think about it for yourself. If there are bears there, if it's really bearish, they're going to show power by busting that support, making lower highs underneath that support and trending down. If they get underneath that and take all the weak hands out and snap back hard and go back up in the direction of the prior move, you already have to be thinking to yourself, they don't have any power, these bears. If they did, they'd break it. So why am I getting bearish? Don't listen to the excitement and the elation and the noise. Read the price action. Conversely, if you're riding up to the top like those people in that wind chart were, and they get above the high and they're all excited and thinking, man, we got a breakout. This is gorgeous. And there's not a ton of volume and a ton of powerful bars and a higher low to prove that it's holding up there, or beautiful patterns to show follow through. You have to be asking yourself the question, do bulls show enough power to break through this last several months of struggle? Or are pros just selling into this, looking for a retail sucker to buy it? The answer on that wind chart was they were looking for a sucker to unload stock to. And that's what they do unless they prove they want to really move it, and that's reading a breakout. So think about the idea of where you're at. When it's sitting at support and it's bending just slightly under, you have to be thinking, do bears show enough power here to break this? You're reading the test. It's kind of like a little child testing the stove to see it's hot. I can almost explain price this way. The child touches the stove and it's hot and rips its hand away from it. Just immediately a reaction that says, oh, I can't go there. But if it's not hot enough, the child will come back there and test to see how hot it is. And will even poke at it. And those little pokes into support are tests. And when those go in there, finally, when you find the hot spot and you touch the molten lava, you will be thrown back. Those rejections are the testing process of support and resistance. Now, when you look left and you see no difficulty, like in the case of this NVDA chart daily, there's nothing in the way of moving higher, which makes it much easier for it to overcome and keep trending. That's the strength of a powerful stock, is there's very little to the left. That's why looking left is so critical. In the case of Baidu, this is a recent stock that some people have been trading that I didn't want to touch. And that's because all I saw was swing highs to run into that I didn't want to fight. And yeah, they've come and passed some of them, but I just don't want to fight into these levels. I'm looking for something easier. I don't want price to reject and fall $15 against me and have to hope that it didn't come back to my level. I'm looking for less difficulty, less trouble to surmount on my trades. Now, the next kind of support is called a century mark, and it's a round number price such as 100, 200, 1,000, 1,100. These price points act as support and resistance. And just the other day, before I'm recording this, Amazon gapped down on poor earnings and then rallied back to 800. And we actually had people in the chat who said, oh, 800 is no problem. Amazon's a great stock. It'll keep going. That day, it was a short that I didn't take. And when you go back, you'll be able to use my tools to see why it was an easy short. And I miss trades every day. It's unfortunate, but I do. I could have shorted 800, and that stock closed on Friday at 755. So there was $45 to be made on a trade that literally was heatless and easy as pie because of one of these century marks. So I just want you to know, take them very seriously. The round numbers exist in the market, are psychological for humans. Now, hold dollar support and resistance. Generally, what I'm also saying here is that each round number dollar price is important to price. Price may not care about $10.23, but price will care about 11, and it'll care about 10. And if it's at 30, when it gets to 31, it'll notice it, and when it falls back to 30, it'll notice it. Some people believe that every 50 cents matters, but I think the whole dollar, each dollar, makes a bigger impression on the psychology, especially when you change from $19 to $20. Now, I'm giving you abbreviations so that when we talk on social media, like Twitter, we communicate. You have a quicker way of saying support resistance. And these are the abbreviations: S for support, R for resistance, and an SR. Some of you will put RS, but support and resistance, these are how you can abbreviate them. And the reason why we had to have Twitter involved in this process, not just because I love the platform, of course, but because in reality, there's so much to teach you here that following you watching this course, I'm going to be releasing more content to further show examples and explanations and things that I just couldn't think of or that are automatic for me, to keep training you until you see what I see. Now, flipping. This is a word I use, and it has existed for longer than I've been alive. And the theory and idea here is that price is going to flip areas. Prior support often flips to resistance on a move lower. Prior resistance often flips to support on a move higher. These are referred as back tests. So you will see people who look at an entire base on one of Dan's breakouts. It'll break out past the level, move up $4, pull back right to where that level was of the breakout, scare a bunch of people, and then hold a higher low right on top of it. It's a back test. It's back testing that area, shaking out a few and holding it and flipping it from resistance to support. Very common behavior. So to look at the cues in 2015, I just wanted to show you the clarity that I see. And here are 4 bottoms. I only need 2 to determine this was support, and I did find buys off of this support. I did know this area would be resistance by looking to the left. And I did catch the trade, but what I want you to see is that where resistance, when price pulls back, it tested that resistance and changed the role. It flipped its role and held as support. It then came back and held again, again, and again. So if you didn't recognize it the first time, you had 3 other opportunities here to try to buy off of this area, which proceeded to work for multiple dollars in your direction. Or in the futures, this was very large gains. But my point of saying this is that you need to be aware of this. It happens on every time frame. This happens on every chart and every time frame. And we can actually read momentum by how this happens, meaning these overlap exactly. You can see that the prior highs overlap with the higher lows in this case. When there's no overlap, we are actually seeing strength or momentum or power. Now in this case, we'll see that GIMO, G-I-M-O, was finding resistance. It poked above it. Beautiful green bar, you can see, but it closed right on it and then fell back underneath. This was a failed breakout attempt here. And then it finally overtook it in tightly. You can see those really tight few bars here where it made a double bottom, if you know the term yet. But if you're newer, you'll start to see these 2 pokes down were a double bottom, and that was on prior resistance it couldn't get through. And then it rallies up and it creates higher lows here. And these higher lows are on the area of where prior high was. So we flipped here. And then these 3 bars, you can see right here, find perfect resistance above here where it can't get through. Kind of like a flagging behavior, and it pulls back and then rips through there, and then it sits on it. It sits on it for more than a month. It sits on it and rests and consolidates and has a trading range where price is defending this support and selling this resistance. Simple. And then breaks out and moves higher. This kind of stair-stepping, beautiful behavior is what I read in the market on the simplest basis. Now, there's also bearish flips. We can see in BABA what happened before its recent run, that price was kind of trying to move up here, and it held support and then fell through it and flipped it to resistance. Then it undercut that support and rallied up, and you'd think this looked good right here, but it was just filling into this gap area to the left right here. Again, it came up to the top of where the support was of this gap, and it fell back down. And then it rallied up just a little bit after gapping down. Notice it gapped down and rallied up and hit this prior support area as resistance and fell back down. These are the ways I read the market on a very basic level. But I want you to think about this. You can technically create your own trends, your own read of the market's trending, just by on different time frames looking at the last flips. So while everybody in chat is fighting over whether we're still in an uptrend, I look at the last 3 flips on, let's say, the hourly and the daily chart, and I go, you know, I'm not calling it an uptrend anymore. I think we're in a trading range, and I'm going to be careful on my trades, which is why I'm able to transition quicker. Now, support and resistance forms on all time frames. The word is recursive, but it means that you look for it on any time frame it exists. Now, the prior bar high is a resistance point, and that's on every time frame, but it doesn't matter as much to me. That's why I don't go too low. Is on an hourly basis, I'm looking at acceptance or rejection above the prior bar's high and the daily bar's prior high and the daily bar's prior low. You're going to notice something, that these are areas, you know, you'll be all bullish and the market will be caught and you'll be all excited, and then price will go over the prior day's high and it'll peek its head out and it'll get knocked down. That's not uncommon. That was a resistance point. Support and resistance forms on all time frames, yet the value of the locations increase with higher time frames. Why? Because there's more market participants. Now, for some of you who've done this a long time, I know you may find this a little boring and this is too simple, but this simplicity is what I see being missed by everyone in the chat room. I see this so commonly, that people are buying up against resistance without massive volume to prove a breakout has started, or without any higher low near it. So they're running into a spike where rookies are all running toward the door and they're all going to get squashed. Now, notice in this chart with the white arrows that we're overlapping support and resistance. This is very common of a weak trending environment or a trading range. Notice when resistance and support start to separate. This is gaining strength. We are not overlapping. This support is above the resistance. We're leaving space. So on this simple chart, we have more trending information, strength, momentum information, power, trend information than most people can figure out from looking at a chart. And this is from grade school level information, but people forget it and people don't use it. Now, I put in a chart here how the prior day's lows act as support in an uptrend. And notice the behavior as price breaks lows in an uptrend. Breaks below, no follow through. Breaks below, back above. Breaks below, closes higher. Breaks below, closes higher. Breaks underneath, rallies up and takes out the entire previous couple of days. This is the reaction of an uptrend. Yes, they will shake out underneath like they did here, but there won't be any follow through. And this is so common. While people will go and see a close right under support and say, oh, it's over. Ugh, I got to kill this thing. It looks terrible. And the next day it's going to pop right back in the range. And it was done to fleece you of your position. You need follow through in the opposite direction to even prove the trend is even possibly changing. But invariably, humans are to be tricked. And so that's why this is something that they get tricked by. In a downtrend, and this was LN recently, why everybody was trying to buy it, I was wondering why. As I saw that each time the stock made the high of the day, it would get above it and it couldn't go anywhere. I mean, like literally, it was closing down each time. Look at the one time it closed up. It gave fuel or octane to the next drop because price didn't like going above the prior day's high. It felt uncomfortable. And that's what happens in a downtrending move is sellers show up every time there's strength. So no follow through higher in a down move is weakness. You can look for the trend, like I said before, in the flips by simply looking at your last 3 flips that have occurred in the market. Simply the last 3. A trader can understand the trend on that time frame. So if you go to the hourly and you look at 3 major swings and you see that price is making a higher high, then a lower high, then a lower low, it's all over the place, you say to yourself, we're caught between 2 levels. I can see it clearly. You know where your edges are. So you're going to stop executing in the middle. You're going to stop looking to buy anything that's strength. You're going to notice that you're in a range and you're going to adjust accordingly. Now I want to show you our weekly S&P trend. And this is using the ETF SPY. It's a weekly chart. And again, all of 2016, we have done nothing more than stay inside a range of the bottoms here at this number right under 185 and the tops here. We have attempted to leave that range recently and we're back underneath it. So we're in right now the trading range area. Of course, if we break this descending line and start flying, we're trending again. But if we don't and we keep falling into this region, we're just in a trading range. We're not trending, but we're not downtrending either, especially on this time frame. And we're going to talk about what the S&P ETF, this is a daily chart of it, and let's look at what it's doing right now. It found resistance. It flipped that as support with a little momentum in between. It found resistance. Now it has found lower resistance and lower support. The trend is weaker right now. Could this be a top? Of course, but if it's going to be a top, this area and this area is going to be where price finds resistance. And it will flip these areas and stay below them. As of when I'm cutting this video, we broke on Friday below the support and we're seeing some weakness. Do I want to take longs at this moment into that level now that it's bent and closed? Not yet. I would need to see a reaction and some proof that it's back in this pattern and it wants to go up here. Now we're going to move to the advanced layer of support and resistance. And for those of you who have been saying, oh, I know this already. We'll get into some things maybe you don't know. A move past a support resistance level, which reverses sharply, is most often a trap. Some of the strongest moves in the market come from these quick reversals or shakeouts. And they can come from a support and resistance flip from price, moving up to that level and retesting it, or they can be done with a gap. So here's TMUS. This just happened the other day on T-Mobile. And I called this in chat and said, T-Mobile's along and I'm interested today. And the reason why was because the gap that happened that day on earnings news, I believe, was nearly holding to the tick and opened right to the prior resistance of the entire basing area here. So price had come up, pulled back, kind of made a flag behavior, held this peak, couldn't get through it, and then gapped it nearly to the tick and held. That's a long to me. Now, it may not be a long-term long, but it's a trade for me. So I will go down to other time frames and I will search for a pattern or some other tool to get into that trade. I got to find 3 to 5 reasons to get in, not just one. But this was a powerful signal. So yes, when you see me going long first thing in the morning without waiting for the opening range breakout or almost looking like I'm jumping for it, it's because I see instantly there's a change in behavior that most people are not recognizing. Here's an example with light that I blew personally. Here's a stock that finds resistance, basically has this pullback here, top of this basing period right in here where price finally gaps up and it flips the top, and it actually is nice enough to come back and test it and scare some people out, which people who don't understand price would have said it's falling apart, but all it did was test the gap area and held. This made a gorgeous long. If I had seen this, I would have said double bottom along with holding the gap, along with flipping the resistance, along with X, Y, Z that I could find. And this is a gorgeous trade with little or no heat. Just, I mean, this is 28 to 46, 44. I mean, easy money that I miss sometimes, and I blew this trade. Blew it. Just missed it completely. Simplicity of understanding a trend. Here's a stock Melly, which nobody was really talking about, but I did see something happen in it. And that was, you had this gorgeous uptrend, just gorgeous. Just the arrow shows you how beautiful this uptrend was. And it wasn't too steep pointing straight up. It was a nice smooth uptrend. And price had resistance, which it couldn't get through. And you can see it kind of has some tight behavior here under this level. The highest peak was right here. And you can see then one day, earnings news or whatever, it gaps that. It could have gapped up here, but it pulls back and it holds it exactly on this day. So you go to a lower time frame and you find your reasons and you get along. And that stock that day went up, well, more than 15 points, it looks like here. You know, yeah, it was a beautiful up day. I mean, just gorgeous. You can day trade things like that. Now it works both directions. Here's an example of Twitter. I had this from $15, this stock, and I did it from finding multiple layers and reasons to try the trade. And yes, I traded this well, but this was my pet and I shouldn't do that. In the case of this one, it gapped up and you'll notice it climbed up and then it was rallying and then suddenly bad news and it gapped down and was right underneath this gap up area. So this new defense area turned into being resistance. And you can see price jettison from that area. Next day, inside bar, closes at the same level. Poof, gone. Just stock falls apart. And that is the benefit of reading flips. Now, here's something that most people don't know about the market, and that is something called a Virgin Mid. This is a tool that I don't know that anybody understands fully, but maybe pros do. But I have noticed that where price turns, where a swing point develops, for some reason, there are so many market participants that are necessary to turn price that it creates an indelible mark or a mark within the record of history, and it creates memory. That memory causes price to react to it. So while price often will make double bottoms and double tops and other patterns, I will often see price stop dead in the curvature, the turn area of the bars that made that turn. So in this case, that price is right here, and price comes right back and holds that area. That is an invisible support resistance line. And you'll see it everywhere. You'll see price gets through here and it stops right here. You'll see price gets through here and it stops right here. In this case, it made the higher high, I think it's even double top. But my point being is you'll want to look for this. It is very common for price to, when it doesn't make it up to or make it down to the double bottom or double top, it'll hide into this little tiny crevice right here. Now you can add these tools together, and you're starting to see it, that you can add tools together for even more information. An example of more information is adding the clues together. In this case, Win rallied up and it came back and it filled this little gap area in here and it dropped into this virgin mid. And it's virgin because it's never been tested into that area deep enough yet. If it's been tested before, it's used and abused and it's gone. We don't count it anymore. But if it hasn't been tested, the test is the first time and it matters. In the case of this one, you can see that price filled into here, into that virgin mid. It even gaps up and pulls back and fills its gap into that little virgin mid. And that's what held Win on the bottom side. So again, trading isn't about just the execution. We can look left and have 12 clues we put together and say, it's done this positive, this positive, this positive, this positive. Wow, this is a good acting stock. Now let me use a couple of tools and find a good entry. This pattern is worth the entire class, but the M bottom is one where it's just so clear that it needs to be protected. So an M bottom has some requirements. The idea here is this must happen in a downtrending move. Price must have fallen. Price must have dropped before this. And the reason for that is we need people to be bearish on the stock. We need negativity to exist. We need it to be falling. And then price will find two defined rejection points, and they will be almost even. So here is the first rejection on Baidu, and here is the second rejection. Now, the reason this spot is important is because above this level, you have to imagine that we have to think when we're trading that much of why the best moves happen is because of stops being nailed. That's one of the reasons why trades work so well when they do, is you nail participants. Well, above this level, shorts have laid out all their stops. The rookies have laid them out exactly at the same top, or 1 penny over. The more educated or professional traders or the funds, they may have the thought that once it gets above there, they'll consider covering. So what happens is, price in this case makes a lower low and it rallies up and it breaches those two peaks. And in this case, what's gorgeous about it is it pulls back as resistance, flipping to support with proof right here. Note, there were 3 days of proof. Not one bar, not a 5-minute bar. You had 3 days to go and review price and figure out a pattern and some other tools that gave you the reason to go long here. And if you did, you had a stop that was minuscule right down here underneath the 3 days, and you had a target that was potentially up here, or risk-reward formula based that took you from 28 to 38 with less than $1 maybe stop. So yeah, it was an unbelievable trade. But what's most important is to think about the psychology. It's moving down, people are negative, people are laying their stops above there. Pros even are thinking if it gets above there, we may have to cover part of our position. It's not looking so good. The longs, the guy who's trying to catch it off the lows also is buying here because he thinks breakout. So everybody is jumping to one side of the formula. They're all jumping to be buyers because shorts, when they cover, are buyers. So we're getting everybody caught on one side of the boat. Here's another M bottom. This was Facebook. Stock dropped more than 50% from IPO. This stock was awful on the open. It was a poor release of a new issue. The stock fell apart and now it's down at $20 down here, and it makes some peaks in the low 20s. And you'll notice there are two peaks, one and then a second peak it tries to overcome and it falls apart. And I love the rejection. I love these gorgeous pullbacks away from it, showing that it really hated that area. You'll notice that price, when it finally comes back up there, it rallies past it and even comes back and pulls back a little bit and rests above that level. That's even more proof to me. And then the stock made a gorgeous move. So within this tight little area, you're making an attempt, and it produces this much return, far exceeding 5 to 1. That was the low on Facebook. Here's the low in 2009, I believe, for Priceline. And this trade I called live, and too bad at that time I didn't have that much capital to afford to apply to a $200 stock, and I was making excuse for trading cheaper names. But here's a stock that was beat up and fell down, a leader, and it made two gorgeous peaks. Look how gorgeous the rejections are. One pulls back to the lows. Second one pulls back to near the lows again. So nobody's a believer at this point. And then it overcomes and it closes on top, right on top of it. And then that was it. It just jettisoned away. Jettison. I think that stock moved from that point to $1,400 plus. I mean, it never came back to that level ever. Here's a bottom in 2016 that happened in V. I missed this one. I was not looking at Visa. This is the mistake of not doing enough homework. But when you miss them, you miss them. And this was not doing homework. I didn't see it. But Visa had been coming down. It found two beautiful rejections of this level here. This was the most gorgeous break of the level. You can see how powerful this broke. It may not have had the highest volume, but I know what psychologically is happening to traders here. It gapped and held 3 days here of support. So I could have even entered here. It didn't have to be a buy here. I know that the chart has changed. The structure and the psychology of the chart has changed above this level. So it was a buy even right here. You could have used other patterns to get in, and certainly I always require a lot more items than one. But this is the main structural reason why I would consider that trade. Now, stepping away from the M bottom for a minute, I want you to recognize that bases, trading range that create bases, the bigger the base, the bigger the moves generally. So what I'm saying to you is when you see long consolidations and you pass by the chart and say, oh, this thing has been lame for a year, you're making a mistake, especially if they had a prior up move and you're looking for another up move. If they've had a 20% up move, as you'll learn in that book, How to Make Money in Stocks, and they consolidate and it's lame for a long period of time, the more quiet it is, the more volatility contracts. And the quieter it is means when it finally becomes big bars. See, price goes from little bars to big bars, back to little bars. The volatility contracts, and then when it finally breaks out of that, look how powerful the move is. It gaps up, it never returns to the gap, it does a pullback, it breaks out of that pullback, it pulls back to there, holds the resistance as support, makes more higher highs. This is the strength that this power provided. In fact, usually people will try to measure patterns and say distance of this move afterwards should be the distance at least of the distance of the base. But it's often much more, much more. And the stock can even be garbage. Admittedly, I've tested this on Walmart and other stocks, stocks that were not even high quality. When they create a big base, they'll still move 20%. It's just the way the market works with contraction of volatility. After a shakeout, I've mentioned this before in this discussion, but it's too important. Trading ranges, bases, support resistance tests, trend line tests, all of them move stronger with a shakeout, which causes fear and pushes weak holders out of positions. When you push weak holders out of a position, you end up creating snap moves, fast moves, and that's very important. In this case, you'll notice the shakeouts here in BABA. There was a test here, so we have our first support point. We then undercut that support point just slightly and shake out, and we got some weak hands that come underneath that low. Then it comes again and tests that area and undercuts this line, but it's not undercutting this line. Then it finally undercuts all of this, and the weak hands get ripped out. and then the stock decides to finally break out from that basing area and fly. We create a simple trend line, and you can see it just rallies up from there. The stock changes composure. Some of your recent trades have been ignited by shakeouts. In the case of Momo, here's a stock that undercut the two major swing lows from earlier in the year and then ripped back in. You can even see the volume right here, as volume shows interest from traders. That's why volume goes hand in hand. Price is always first to me. Price is number 1, 2, 3, and 4. And then volume is number 5, basically. There's nothing more important than price. But volume shows conviction, it shows interest. Look at the interest as it snaps back above into the range. As soon as it's back in this range, you have to be thinking, unlike the rest of the people, wait a minute. They all thought below me that it was dead, but it isn't dead yet. And then it creates these gorgeous tight consolidation patterns with resistance and support so close to each other. I have to admit, I love these because the stop distance is so tight. I mean, if I tried to buy right here above this consolidation, my stop only needs to be, fractional numbers below me. If I wanted to buy above here, right here, fractionally lower stop. So it allows me to get in much tighter areas. But I still am not going to buy up into this red line here because I know the resistance is there. So I want to be as close to this side as possible. So I have my right formula distance to get there. Screw bars. This is an advanced bar type. And while I'm not talking about bars in this part of the chart, it is a gap on another time frame, and I need you to see it. These bars provide very strong moves. In the case of CWEI, this was recently a chart talked about in chat where somebody said, Dan said it didn't look good, and then it did something unusual, and I want you to know that it was unusual. Most people didn't recognize it, but it was really unusual that you see it this gorgeous, how it occurred. And that is, you have a strong uptrend. That's why the green arrow is here, strong uptrend. And I want you to think about the emotional state of the people on this down bar here. They've undercut the last 40 bars, 30 bars. People are worried. They're negative. They're starting to think that maybe it doesn't look so good. And there's even red volume in this one that was higher than average, showing there's definitely some fear. And the emotional state of all these people are get out or sell it doesn't look good, or afraid, or even shorts are stepping on it, thinking this looks terrible. It's just rounded the top. I'm getting in this. Then the next day, just opens the day over that entire bar's high. The weak bar followed by an incredibly strong pop over the top of that bar. That means everybody in that prior day has been trapped. They're jammed. They're stuck. If they're short, they may be losing. And then other people start to jump on it because they say, wait a minute, it just gapped up. It looks good and it's acting good. So you have a bunch of retail guys all buying because of that gap. Basically, what has happened here is shorts have to cover, and longs or people who are aggressive that look at it see even a trend line break. There's a little trend line that broke here. And they're all getting positive and rallying it up. Price, for some reason, when people are trapped, rips. And in this case, it ripped up. Notice, I want you to notice, it made it into new highs. And while somebody in chat was screaming, it's going to go higher, it's going to keep going, it then hit new highs. And what did resistance do? Resistance played its part and it started falling right back down. If you don't read reactions, you can't see what's going on. This is exactly how I call trades in chat, is reaction to reaction to reaction to reaction. Not magic, skills that we learn. Here's another one, GIMO on earnings. I love this. This is a strong uptrend. We have a nice support level to the left, but it's looking kind of a little bearish and then closes horrible underneath the entire consolidation. Everybody here is sold out from earnings. They're afraid, they're fearful. And the next day, what do you know? Gaps over the high of all of those people. Every short that's comfortable, every long that's sold it. Whoops. And you get a nice rip-roaring, beautiful move. Those bars are to screw people. Support and resistance provides our risk reward. This helps us to select locations for our stops. that allow the distance estimates to reach our 5-to-1 minimum formula. Support and resistance we have done here is on a horizontal basis. We're going to find out that it isn't just a horizontal basis. There is a problem with support and resistance that I need you to understand. Support and resistance are an area or zone of price. They're not an exact price. Did you see those tests that were underneath? They bend. They test a little bit in. That gives that poke, gives it even more fuel when it reverses and has a shakeup. Because of this, other tools and layers are needed to develop a tighter entry area because these zones can be larger. You're going to get shaken out using just flat horizontal support and resistance. This is why we need layers. Because if I just show you a support level and say you're going to buy near here, you can say to me, fine, but when it undercuts by $1 and shakes you out, you're going to say, I missed it. And I'm going to say to you, that wasn't enough. Let's add up our tools and find a good entry around that support area. Now this ends this video on learning support and resistance. Next, we're going to learn other tools. But I want to break this up so you can stop and review it and understand the theories before you move on. You do not have to watch all of this today. And some of you who think this is too simple up to this point, you're not seeing the simplicity value yet. If you can read this aspect, and soon you'll be able to read it without even drawing the lines, you will be able to read what price is doing at all times and understand what it's telling you. Completely understand what price is doing. So I'm going to end here and we'll start the next video. That would be video number 3. This is video number 2, and we'll see you soon on the next video. Take notes so you can ask questions. Thanks.